morning, everybody, and welcome. Welcome to the Go Further Index webinar. I'm Nicki Clark, Chief Exec here at UMi, and UMi is all about helping businesses go further. And we do that by making it easier to find and use the best information, expertise, and finance. And if there's one thing that is usually on all business minds, it's money. It's making it, saving it, managing it, or getting more of it for a particular purpose. So today I'm delighted to say I'm joined by some of our partners and my colleague Laura Ferguson, who you'll hear a little more from in a second. And they're all about making it easier for businesses to access investment and the right sources of funding around the theme of innovation. So what we want to try and achieve today is to help you understand why it's important to find the right kind of finance to underpin innovation and give you the connection so that you can go away and do just that following today's webinar. So I hope you enjoy the session. Hopefully we are hosting this still from home. So hopefully people like postmen, dogs, kids, etc. are all going to play ball. But please forgive us if they don't. So without further ado, I'm going to ask my colleagues around the virtual table to introduce themselves. So first of all, we've been really lucky with the Go Further Index because we formed a fantastic partnership with some awesome businesses, and many of those partners are around the table today. So first of all, I'm going to go to James Gunnel, please, MD of Global Corporate Venturing, one of our main partners in the Go Further Index. James.
Yeah, no, brilliant. Thanks for having me, and yeah, excited to be here. So Global Corporate Venturing, really, we're a global multimedia company, a market intelligence platform that publishes sort of the news, insights through our corporate university impact and innovation venturing channels. We host global events with flagship conferences in Silicon Valley, London, Tokyo, and Sao Paulo. And really, we're there to sort of track the people, the companies, the deals, and the sort of emerging trends that are shaping the future of innovation and capital. And we're really looking to provide the sort of information, insights, and access to the global investment community to help them succeed in a constantly changing world. We just won a Queen's Award for International Trade, and really through our partnership with UMi, CPI, Factortech, Heriot-Watt, and other partners, we're keen to expand our kind of homegrown UK credentials in the investment ecosystem. I've got a background in sort of media and publishing. I worked for about 8 years at the FT as a managing director, and they're sort of running their global events business. And that really got me interested in that sort of future of opportunity in terms of in industry, society, and how those kind of innovation ecosystems can drive forward and power sort of growth and the future. So I'll hand back to you, Nicki.
Brilliant. Thanks, James. And I forgot to congratulate you guys on the Queen's Award. Absolutely awesome achievement, and particularly in today's world when some people are finding international trade and trading overseas quite tricky, but that might be a feature, I'm sure, throughout this morning's discussion. So if I can go next, please, to George Weir and George Nianias from Factortech. So please do introduce yourselves, guys, and tell us a little bit about Factortech. But I'll let you mediate that between the two of you.
George, you first.
Oh, good, I got the short straw. So we're involved in advancing credits to small companies, usually between 100,000 and 2 million. What we do is we're looking for companies that are too small to go to Barclays and the big banks. They're typically pre-Series A, but who've got government grants and who've got HMRC R&D tax claims. So we started as a company that was a receivables financing company, and we've ended up specializing on companies that have got these two sources of income. Typically, they're technology companies, which is just as well. Because George Weir will tell you about his own background. And my background is I'm a fund manager, ex-fund manager who ran SME money in, of all places, Eastern Europe and Russia. And before that, I was a banker in London and a risk manager, head of risk management at Warburg, and I studied mathematics and mathematical logic. So we both find the sector interesting and exciting. The smaller companies, the messier ones, they're getting their act together, they've got IP, they've got a great idea and believe in themselves, but dealing with the big lenders is premature, and finding equity tends to be a bit onerous because the equity people breathe down the neck, the equity investors. So we're kind of bridging the gap between Series A people who can go directly to the equity markets and people who have just got an idea and are still sitting in the bedroom thinking what to do next. That's where we come from. But George Weir will now tell you about why he's relevant in his background.
Brilliant, thanks.
Thank you, George. Very briefly. Originally, in terms of my background, electrical engineering, but I ran an incubator in Strathclyde University for 3 years back in 1990. Following that, I became a starter-upper, and I've been in the startup space, scale-up space, and advisor to companies since 1990. Love what I'm doing and very grateful to be here today, so thank you.
Thanks, George. I love the phrase starter-upper or word starter-upper. I think that's brilliant. We need to get that fed into government policy because it's a much more friendly way, I think, to describe these things. So without further ado, and last but by no means least, Laura Ferguson.
Yeah, good morning and thank you for having me here today. I'm Laura Ferguson and I'm an investment executive at UMi Finance Scotland. To tell you a bit about my background first, my background is in personal banking and I have quite a long history with ultra high net worth clients, both at Bank of Scotland and at Barclays. I joined the UMi team in March last year, just before we went into lockdown. So it's been a really interesting start to my career at UMi, but really, really good. We've managed to develop a good working relationship with the team, albeit virtually. The UMi Finance Scotland team manage the Scottish Government Growth Scheme, and that's a £12 million fund that we lend to small and medium-sized enterprises in Scotland that are looking to either innovate, diversify, they need a bit of growth funding, or possibly just some working capital. So we also do equity bridging. And that's across a huge different range of sectors. Because we sit as a gap funder, we tend to do a lot of technology companies in the early stages that can't get funding from the banks. So a lot of the work that I do is within the tech sector, and that can be med tech. I've just funded an agri-tech business in the last couple of months, and educational technology as well. So a huge kind of range of sectors. And along with actually providing the funding to companies, we also help them with introductions to people that we might find useful for them to help grow the business further, and any sort of other general advice along the way that we think could help enhance their business. We spend some time with them doing that as well.
Brilliant, thanks, Laura. And of course, it's not last but least, because I have saved the best for last, because I need to introduce Paul Devlin, who is Head of Commercialisation at Heriot-Watt. And we're really keen to understand and hear a little bit more, Paul, about the new grid facility. And you've been kind enough to host our Go Further forum in November, which we're super excited about. And hopefully it's as the grid facility unveils its doors. So tell us a little bit more about that.
Thanks, Nicki. Yeah, so I work with Heriot-Watt. Heriot-Watt's a 200-year-old anniversary. We're celebrating our anniversary this year. And we've got a background, science, engineering and business. And what the grid building does, it brings together all those different disciplines. So we've got engineering labs next to computer science labs, next to business incubation space. And the idea is that we can bring together students, researchers, staff, and industry all together to collaborate on business ideas and industry challenges together. So we're really looking forward to welcoming everyone to the facility. It's been a year since we were in as well, but hopefully by the end of the year we can welcome everyone in. And I suppose that the rest of my role at Heriot-Watt, it's really to look out for startup companies, spin-out companies, and industrial collaborations. So on spin-out companies, we did 4 spin-out companies last year, everything from medtech to computer science. On startups, we had 170 business ideas that came from our staff and students that we've been working with. And then on industry partnerships, we're looking to bring in companies that might want to collaborate with our researchers. And we moved in a space tech company called Celestia. They arrived on campus. They've started to recruit our PhD students, and they're able to set up a manufacturing facility at our campus in Edinburgh. And we're also a global university, so we've got campuses in Orkney, focuses on the blue economy and renewables, one in Galashiels, which is textiles, and we've also got campuses in Malaysia and Dubai as well. So yeah, it's really looking forward to welcoming people to the grid, and looking forward to the discussion today. Nicki?
Brilliant. Thanks, Paul. I think it's going to be really interesting to hear from you today how that collaboration works in practice, and how, whether or not, space is important in terms of physical space, because after the year that we've had, there's a lot of people are saying that physicality has still got such a huge part to play, particularly around innovation and collaboration, and also hear a little bit more about your partnerships overseas, which are going to be increasingly important to the economy. And I do think now we've been joined by Alfredo. Alfredo, have we got you? Yeah, we've got you. Brilliant. Nice to see you, Alfredo, and welcome to This Morning. Can I just ask you to introduce yourself, Alfredo, and a little bit about CPI?
Sure. Hi all. Great to be here. And apologies, I've had problems with my internet hub, so I didn't have a connection since 9:45 this morning. I've been
don't worry.
Let's to get back in. So glad to be here. Alfredo Ramos, I'm Managing Director at CPI Enterprises, which is the Ventures and Investor Engagement arm of CPI. CPI, we are an innovation center based out of the northeast of England and Scotland. And we're there to help companies develop their products and processes and bring them to market. So what we have is a range of technical capabilities to support companies scale up their manufacturing processes and being able to commercialize their products. In terms of areas, we're quite a bit of an eclectic mix. We cover everything from biotherapeutics and pharmaceuticals down to activities in the agritech space with sustainable protein production and formulation of new additives, for example, for that particular space. And we also have capabilities in the electronic space, where we primarily look at Internet of Things and how we can support the rollout of low-cost sensors to fuel that Internet of Things.
Brilliant, thank you. So what I'd like to do to kick us off in terms of having hopefully a really good discussion and debate, but one that leaves businesses that might be watching this webinar with a real understanding about what kinds of investment they should be looking for to drive and fund innovation versus general business growth, and also understanding how they go about doing that and creating the connections by which they can go and do that. So if we kick off with considering that very fact, is there a difference between the kind of investment that you need when you're looking to innovate as a business versus drive general business growth? And firstly, Laura, I'll come to you on that point, if I may. If you can give us your view on whether or not there's a difference, and if so, what that looks like. And then colleagues, please just feel free to join in.
Yeah, nothing like being put on the spot to go first, Nicki, thanks. I think looking at the general growth of the company, that could involve kind of several factors. It could be to increase their product, service, or offering of what they've kind of already got, and kind of driving the sales and marketing activities to highlight what they have. But looking kind of at the innovation side of things, that would be focused on either product or process innovation. So either looking at innovation to create a new product that's unique to the offering and new to market, or increasing the efficiency of a process that they already have that might help reduce the costs and things. So when we're looking at a business case, there is quite a clear definition whether this is existing growth of the business and their offering, or if it is kind of true innovation funding. And that'll determine which sort of recommendations we may make to a business, because certainly when you're looking at innovation, it might be more suitable to go down the grant route, or an incubator accelerator side, or it might be something that we could consider lending for and kind of co-funding that along with another grant or accelerator program.
And let's just bring in here Paul, because you're seeing an awful lot of businesses coming through, and you're seeing that collaboration across corporates, businesses, professional services, etc. Do you think there's a difference in the kind of innovation investment that's required for innovation?
Yeah, and I suppose it depends on the stage, to follow on from Laura's point. So if it's a really early stage startup, then typically you're looking to say, okay, can we get this minimum viable product? So can we get a basic invention off the lab and in the hands of customers? And then who are those customers? So typically at that front end, you're looking that growth is starting from zero. You're looking to just say, can I find my customers? Can I understand their problems? And kind of work out, have I got a minimum viable product to satisfy that? At the later stage, we're seeing a little bit of collaboration. Say it's the space industry. So we're seeing collaboration between our researchers and some established companies in that field, and they will look to collaborate with our research teams, and the route to market for that might be a joint venture, right? So it really depends on the stage, Nicki.
That's really interesting, that whole notion of actually investment can come in all sorts of different forms. Rather than it be put through an investment agreement, it can actually come in the form of a joint venture as well. Perhaps that's something we can explore a little further. And I suppose that's a lovely segue into James, the kind of corporate venturing world. Tell us a little bit about that with reference to the investment piece. Oh, I think you're on mute, James. Somebody had to do it, didn't they? Somebody had to do it. So
okay, can you hear me now?
Yeah, great.
I think I was put on mute, maybe not. So I'm thinking about corporates. We did a survey recently where they said I think 80% of corporates believe they're at risk of disruption. So ultimately, innovation is key for corporates, and within that tool set, there's the whole sort of innovation theme. There's various ways that corporates can innovate, and that could be through sort of buy, build, partner, or invest. And I think that the key is it doesn't always have to be an investment with a corporate, as you say. It can be really that partnership opportunity. And I think when we talk about corporate venturing, we're thinking about those kind of open innovation themes. So bringing the outside ecosystem into a corporate. And that can be through the sort of financial investment of the corporate venture arm, or sort of capital arm, or it could be through a sort of partnering joint venture opportunity that can then go on and could lead to a potential investment in the future.
Thanks, James. One of the things that I'd like to try and draw out a little more, perhaps a little later, is what kind of businesses form partnerships with corporate ventures, because it sounds quite scary, for your kind of your smaller business partnering with a big corporate in that venturing model just sounds a little scary. So
I think
go on.
I was going to say, I think if you think about the corporates, what does a startup need? It needs kind of access to capital, or they can give that for sure. But then beyond that, it's access to customers, it's access to talent, it's access to sort of research, and it's kind of that's the benefit of the corporate venturing model, is that and I think a lot of the really successful corporates, they're entrepreneur first. They're the entrepreneurs helping the corporate solve a challenge, probably, certainly, but then it's also how can the corporate give back to the entrepreneur. and it is through that kind of extended network ecosystem that they have. They could be their first customer. They could open up their existing customer base to enable that startup to go on and grow successfully. So it's a really interesting kind of network and ecosystem. And again, and as I say, even if it doesn't lead to a sort of financial investment, it can lead to, those corporate venturing units are right at the heart of the sort of innovation strategy for corporates, and can therefore really lead on to, connections within the wider sort of innovation tool set within a corporate, which can be quite hard to navigate. But the corporate venturing units themselves are increasingly professional. They sit right, often connected to the board of the said corporate. So they're really tuned into the corporate parent sort of business unit needs.
And what you guys specialize in is finding and brokering relationships with those corporates who are experts at this. This is what they do, and therefore they're well attuned to the needs of innovative, perhaps smaller businesses, and they've got well-established practices. And I think that, for businesses that might be watching this or dialing in this morning, just broadening that kind of thought process, being a little bit more open-minded to what investment looks like, because it could be through things like corporate venturing, your access to your first customer, or as you say, those specialist resources is really, really exciting. So if I can move on to Alfredo in terms of what CPI are doing in that space, because I guess a little bit like Paul and James, you're acting as this kind of facilitator and broker and spotter of innovation, as well as harvesting innovation yourselves. So what are you experiencing in this area?
Yeah, no, indeed. I mean, just think about some of the comments from the other panelists. I mean, there's clear data, for example, that, if you think about investment and how corporate investment can help startups in their development, there's a reality is that startups backed by corporate venture capital are more successful. If you look at those businesses that, for example, exited or were seeded between 2018 and 2012, that raised 2 rounds of investments, you'll see that probably about 35% that were backed by corporate venture capital were more successful, exited compared to only about 25% of companies that didn't have any backing. So actually, and that is it's a similar statistic as well with a number of bankruptcies. So you see a higher level of startups going bankrupt if they didn't have corporate venture investors compared to those that did. And from our point of view, I think what you can bring as a corporate investor is the understanding of the market and the closeness to the customers that possibly a startup that is still iterating around not only its technology but also business system, a business model may not have. And just bringing them so close to that particular end market, I think, is a huge advantage, apart from the sales and distribution channels that corporate may have as a partner. Now, we obviously operate at a much earlier stage, if you wish. We're at the stage where companies are still even working on their technologies and proving either that their technologies work in a lab. More crucial and more relevant to us is proving that you can manufacture those particular products in the large quantities or in the quality that you need, or consistency, for example, if we're talking about pharmaceuticals. So in that very early stage, I think what we can provide to businesses is an acceleration of their growth. It's the fact that you actually can, if you think is innovation as a service, the fact that you actually don't have to make material commitments on the technology side from a very early stage, but you actually can work with parties that have the whole infrastructure that you need, that you carry out innovation. Let me be a bit clearer with my statement here. If you're a startup in the life sciences space, you will have to work with, you will have to establish a lab if you're going to do everything by yourself. You would have to hire the right people. You have to bring in standard operating procedures for that lab, certifications, etc. And that requires an awful lot of capital. Now, funnily enough, if you compare that to, for example, the tech space, nobody's thinking about building their own data center if you're going to develop a new software as a service platform. But somehow, if you move to life sciences or hard tech spaces like chemicals or new materials, there seems to be an expectation that you're going to do all that. And I think this is what we're trying to change here, is to say, look, there's a similar model. You don't build your own data center every time you want to create a new company in that space. Why would you do that in these other deep tech spaces? And now what we can provide there is basically access to not only finance through grant funding, which I think is important. I think, to me, the more important aspect of grant finance is the fact that you can bring in partners in corporations or potential customers that can help you in that journey of discovering what your product is and what your business model can be, and also proving the demand for that particular product or service that you're developing in the market. Now, one of the things that we realize is that that grant funding space, let's say from statistics that we ran among our own clients, we saw that approximately that covers, or basically companies would need 10 times the amount of private money that they managed to secure in grant funding. And that's something that we've seen with incredible consistency over the 15 years of CPI's existence and the statistics that we've collated. Now, grant funding will only help you to get to a certain point. You then need to move into the private investment side. Yeah. And what we found is that very often entrepreneurs have to build those networks with investors from scratch. And we thought that being a partner for both, I think, investors looking for new investment opportunities, but also companies looking for that investment, what we ought to do is to maintain a network of investors. And that's what we're doing in enterprises. It's basically about connecting people, just finding opportunities either side, and being able to sustain that dialogue between entrepreneurs and investors, so we can actually accelerate the process of, seeing these news opportunities, evaluating them, and then actually potentially investing in them. Finally, as you said, Nicki, what is also important for us is we think that we have a role to play as well there in catalyzing that investment. So we come in and step in as co-investor to plenty of parties. If we establish our investment team, so we go through the exactly same exhaustive process that a venture capital fund would do, and we have our investment committee, and then we'll make decisions on investments in certain companies. So far, we've made 6 investments, and we'll continue to do that going forward.
Brilliant. So that kind of that notion that when you're looking for investment, don't just think finance, don't just think money and pound signs. You've got to think more broadly than that in terms of what does it leverage, in addition, in terms of resources, in terms of connections, networks, ability to grab your first sales order, or indeed prove your concept at a scalable level. There's some reoccurring themes here, regardless of the sort of finance that you ultimately, or investment you ultimately end up looking for. And those connections, building relationships with organizations like these around the table, those connections are so vital in this area. So I'm going to come now to colleagues at Factortech, and you guys are operating in really quite a niche specialist space, but one that touches so many businesses, yet so many businesses aren't doing it in terms of leveraging R&D when they're doing their innovation. So tell us a little bit more about that, guys.
You want to?
I don't know which George wants to take it first. You guys go ahead.
Okay, so to simplify things, we look at the need that the client has, the customer, they ask, and balance that with R&D tax credits. It might be receivables, it could be innovation grant, intellectual property, and as long as the numbers stack up, we can give that flexibility as the company grows, because the company's plan might not work out. There are hiccups, bumps on the road on the way through, and we're there to be as flexible as we can, with the as long as we can get the aforementioned credit side of the skills to balance up. So that's generally our approach. And in recent year, innovation through intellectual property has been one of our things. And as long as we get intellectual property valued by industry experts, we can also include that. But George, have I missed anything on the?
Well, no, I think it's very interesting to go back to what Paul said at the beginning, where it depends on what stage of a company's development we're looking at. The key that that I think that Alfredo mentioned here is that having venture capital or having capital in gives a much better chance to companies to do well, and I think that is true. What we're trying to address is the case at the beginning where companies don't have enough capital and they are relying on the tax credits and the grants to pre-finance some of their to pre-fund some of their receivables and to use their assets as our way out if things don't work out. It's really interesting to look at people whose concept hasn't been proven because they think they've got an idea. And by the time they've come to UK Innovate or Horizon 2020 or anybody else at EIT, we are able to see that there is something in the idea. Whether it's enough to take them to clients, to take them to corporate venturing, isn't clear yet. But what we are prepared to do is to say, look, guys, you've got a little bit of cash in there. You've got a grant. We will pre-fund the grant part. And by the way, we will also introduce you as far as we can to other people. So like some of the other panelists here who are able to complement what we're doing and therefore give the people a better, bigger horizon. Because as everybody said, when you start up your own company, you can't see really what the horizon is. You're very busy creating your invention. And therefore being able to bring up other people who are able to help them on to get to the client, which is the holy grail, is something that we're very keen to help with.
Yeah, so that initial, I guess what's coming out here is stage is really important to thinking about what kinds of investors or investment is right for your business. And at that early stage, that really crucial working capital to make sure that you can continue, as you say there, George, to focus on product development, etc., is really, really important. So just to be really clear about what you guys do, because for many businesses, the whole R&D tax credit thing is like a bit of a black art. It's I'm lucky enough that I've got a great corporate services director who does that stuff. But so essentially, is it fair to say that what you guys are doing is taking a bit of that mystery away, understanding whether or not a business can secure R&D tax credits, helping them do that, but you're going to give them the cash in advance as long as you're certain they're going to come back? Is that the right way to describe it in practical terms?
That's it. Yeah, I mean, there's a huge government program. I think that the R&D tax relief program is about £4.5 billion a year. Quite big, and the grants are of a similar size. So the companies need to understand that they can get that there might be something there that they can claim back. They need to find an accountant, or we can find an accountant for them, who will come up and say, this is what you're entitled to get back. They will work very closely with their accountant to provide all the data that the company, that the revenue requires, and then submit it to the revenue. Now, if there are people that we've worked with before, we're quite happy to give them money before they submit it to the revenue because we know who they are. Or if the tax consultant makes a very good case for them, because they typically introduce us to the companies. Again, we're happy to give them the money before the revenue says, before it's submitted. But it's huge. And, after 70 years of experiments, how to fund innovation in this country, from Harold Wilson's white heat of technology, we've finally ended up with a scheme that works. It is a very good scheme because it is a genuine help for people who wouldn't be able to get their companies off the ground otherwise.
And just also to tackle another kind of myth, if you will, if you are often businesses who are innovating and are in the early stages of trading are loss making, and you argue good losses and so on, they're still able to access these things.
Very good question, Nicki. Yes, they have to be loss making. If they're profit making, then all that happens is they pay a smaller tax bill. They've got to be loss making. They've got to have spent a lot of money developing their product, because it's from the product development spend that they get the reclaim.
Great,
So,
because I know a lot of businesses who don't consider this because they're loss making, because they're in that early stage, and they think therefore it's not something for them. So it's just keen to
it's something specifically for them.
Yeah, brilliant. Okay.
Only 20% of companies globally access this very rich form of finance. The assumption for many is that it's only people in white coats, scientists that are eligible, but the majority of innovation, as George has just said, as long as the eligible expenses can be justified, then it's there.
Brilliant. Thanks, George. One of the things that I'm really keen to help businesses understand as part of this webinar, whether they're dialing in at the moment or watching later on, is what are the really specific kind of characteristics that an investor, whether that be a venturing partner, a corporate venturer, or an investor, or organizations like yourselves sat around the table, will look for in a business in terms of that investment readiness. So can I first of all come back to yourself, Paul? What kind of characteristics do you look for?
Well, I suppose for us, Nicki, we're trying to get maybe academics out of the lab and into startup companies, or it could be students. So we're typically trying to broaden the team to take it away from just a technical expertise to try and bring in some industry expertise. It could be financial expertise. So trying to build that team out, and then trying to focus on the customer as well. So somebody who can engage with the customer. And we go through many processes. There's the Lean Startup, there's iCure. There's a number of programs out there where you're encouraged to speak to 100 customers and really try and understand the needs. So we're taking our academics and our students on typically a year-long journey to really engage with our future customers. And then there's the technology as well. And to George's point earlier, we do offer IP protection, so that there could be hard IP assets in the forms of patents, building up your technical skills to get the technology readiness level up. So we start off quite early, and we can be typically on a 1 to 3 year journey to try and build a team, build market knowledge, and build an IP base around about maybe a technology from the university, so that it's hopefully ready for some of our colleagues that are around the table here today. And as a shorthand for it, there's the classic hustler, hacker, and hipster. So somebody who can sell, somebody who can maybe make something, and something who can make it look good, right? So you're typically looking for those kind of people to build your team when you're at that early stage, Nicki.
Brilliant. I love that. That's great. I'm not sure which one I'll class myself as fitting into, but great phrase. James, can I come back to you then? Tell us from your perspective, because you see so many businesses in the events that you run, and you must have done as well back in your FT days. What are the characteristics that really stand out to these kind of partners?
Well, I guess the thing is, it's a complex kind of environment, isn't it? I think to your earlier point about that sort of intimidating, kind of going to corporate, the fact that the corporate venturing kind of arms exist within these corporates signifies that actually corporates accept now that they don't have all the right ideas, they don't have necessarily, the best talent, and they need to go out and find that. But I think it really depends on where, and every corporate's different, everyone has a different innovation kind of strategy, but it really depends on where they're looking. Some are looking very near term for sort of the more financial return. So they're looking sort of later stage investments where they can accelerate growth or answer a particular business unit's need. But then, equally, we're seeing increasing numbers of corporates now sort of going early stage, or much earlier stage than traditionally they would have done before. And again, they're doing that because they're interested in much sort of further down horizons of future disruption, and how they can sort of mitigate that and stay up with those kind of current trends. So it's a kind of it's a very difficult one to answer, because every corporate will have its own nuance, its own innovation strategy.
One of the things that I'm really keen to try and draw out is, and I suppose this leads back to that sort of fear factor a little bit of getting into bed with a big corporate. Does that mean I can only ever sell to them? as a sort of primary customer? I mean, okay, I can sell on the back of their distribution networks, but do I have to give them some kind of exclusivity? Is that usually a characteristic of the arrangement?
No, I don't think so. I think, the corporates are there to enable the startup to go on and be successful. The corporates also want, to get a financial return from that company. So no, I think, part of the beauty of the sort of corporate network is that they will co-invest with each other, and they will bring expertise in from other partners to leverage opportunities. So no, absolutely. And again, I mean, depending on the sector, perhaps it can get more kind of, there might be an exclusivity. But corporate venturing is happening across all the different, multiple sort of vertical sectors. So it isn't just in the sort of pharmaceutical space, it's happening across IT, financial services. And again, you see close collaboration between corporates that probably in the corporate sense would be competing against each other, but in the venturing space, they will be actually co-investing with each other to gain sort of future competitive advantage or insight into a particular technology or market. So they're really, so it's a kind of broad remit there, and I think it's a really interesting kind of nuance between. So you'll see companies co-investing with each other in their sort of vertical space, but then I think the other thing on sort of face value is corporates, particularly on their venturing arm, are interested in those sectors that are currently way outside of their current sort of business model. And that's what they're interested in. So, an oil company might be interested in some drilling additive that will help its current business unit fulfill, around sort of cost, reduction. But they're also interested in quantum computing. They're also interested in, kind of ag tech. And so there can be a really diverse range of investment sort of thesis driven. So it's really a kind of strategic play for many of the corporates, and the challenge they face is to balance off a sort of financial return in the relative near term, but then also be investing in technologies that will support them, particularly if they're working in a sort of declining industry. That they're looking to think about what the future could be for their business and how they can sort of pivot out. And obviously, from a venturing perspective, the risk is lower taking a minority stake in a startup versus a sort of the risk of taking a big M&A play. So they can balance off the two there. But if you think about like an insurance company, say a car insurance company, at the moment they're investing the individual. You go on, you do your renewal. They ask you, how old you are, what job you do. And they base it on those risk factors. But then you think of the existential risk of what happens when cars are driven autonomously. Where does the insurance risk lie? Those are the sort of factors, that are really kind of causing these big industry players, headaches, either now or in the relative near term. Where does that liability lie? Does it lie with the individual, or does it lie with the platform provider that's creating that? So it's those really kind of it's a fascinating kind of area, and again, and I mention that because the sort of corporates are increasingly using corporate venture to get into those sort of earlier stage investments. A, because they can get a sort of better return, but also B, because they're thinking about their sort of future strategy and they're prepared to take risk for competitive advantage later on.
So I'm guessing from a characteristic perspective, before you approach somebody from a corporate venturing perspective, you need to know you can kind of pay the bills. So that working capital that we were talking about previously is super important. It needs to be a stable business. It doesn't necessarily have to be profitable. It could be at quite an early stage, but it needs to be stable. Is that a characteristic that they're looking for as a given, or does that not matter?
I think it depends on. I'm not in the corporate venture. It's a kind of again, I think it depends on the company and their appetite for risk. But again, inherently, as Alfredo mentioned, not all startups go on to be massively successful, and And I think from a corporate perspective, they're willing to take greater risks in the sort of CVC space on the sort of acceptance that, you know, they might not get that return, but also companies pivot. You know, what they're currently doing, they might end up changing. And I think a lot of it is around investing in the talent as well, and bringing in external perspectives and expertise.
Is that something that you see as well, Alfredo?
Yeah,
Is it really that broad in terms of, you know, outlook of what the business would look like?
Yeah, indeed. I think I'd like to support James here because I think that he was making a very important point, and it is, before you approach a particular corporate venture capital outfit, find out whether is it that they invest, what are their key interests, in which mode they're on. I know actually through Global Corporate Venturing, they have a fantastic network. One of the partners actually having a discussion with them, he suggested that, look, we're not here to invest in new technologies for existing markets that we serve, or we're not here to look at new markets, but old technology. We're here to look for new technologies, new markets, things that we're not doing right now, and just trying to foresight and understand what our business could be in a few years' time. But if you look to, let's say, other spaces in the market where you have very large corporates in there, for example, of trading, and I'm talking about trading goods, for example, Mitsui, very, very large Japanese conglomerate. They have plenty of activities in the food supply space. Talking to a company in that space, they probably will be more interested in companies that can help them serve their existing markets and the existing needs of their customers. Therefore, their needs or what they will be looking for in a startup, for example, what they will be looking for is companies that will be much longer in their journey and that might have a very clear idea of their business model, or very close to a product, or already have a product that they only need to ramp up in scale and production. So I think you really need to know where you sit and what your counterpart is interested in what the investment strategy is. And if the investment strategy fits your current stage of development, then you shouldn't be shy at all and have that conversation. But I think some of the mismatch that we hear, and we hear a lot of entrepreneurs saying that, you know, it's very difficult to engage in that dialogue. I think at times is lack of research in terms of what you have on the other side and what the interests are from the other party. Seeking investment or fundraising, to me, is nothing else than sales. And where you're selling, you need to understand what is the counterparty looking for.
That's really, really helpful. And in terms of if we go back to what businesses, the kind of different types of funding, Laura, that we were talking about earlier on. And I'm really keen that we try to help businesses understand, because it is like a big, you know, Venn diagram, or it's quite broad, and it's quite tricky for most businesses to navigate. If you had to give them some advice, because you're dealing with lots of these businesses day in, day out, where would you tell them to start? Oh, I think you're on mute, Laura. Yeah, go on.
Yeah, so definitely to try and start with the grant funding. That's always probably the best place to start. Find out what's out there, and along with kind of any competitions that might be out there as well, because it's not going to cost them anything apart from time and effort. So I know a lot of these things can take days or weeks to actually complete, but if you can get the grant funding through, that's a really good way to kind of kickstart your growth or innovation plans. After that, it really depends kind of what stage the business is at, whether it is a pre-revenue business or if it's already revenue generating. A lot of businesses that are revenue generating often miss that they can actually fund their own growth through their cash flow, and they may actually not need to take on debt or equity funding. So that's something that's always worth reviewing as a business owner, whether you can actually fund the growth. It might be slightly slower and more organic, but if that is possible to maybe get you through another 12 months to be more attractive to an investor, that's always an option that can be looked at. From a debt funding perspective, we assess both pre-revenue and revenue companies quite differently. But the similar kind of attributes to both of them, one of the most important parts is actually who the team are. So who's the team made up of, and also the support network that they have outside of their teams. That might be the board that they've created, or it could be external support advisors, Scottish Enterprise. It could be contact with SIB, SNIB, and various other organisations out there that can support businesses from the outside as well.
Thanks, Laura. And George, Weir and George Nez, what advice would you give SMEs? You're dealing with such a lot of businesses at an early stage, and those that are requiring that kind of working capital field. What advice would you give them in terms of where to start? Oh, I think you're on mute, George.
Am I off?
Yeah.
So taking up Laura's point, 6 criteria that we look at carefully are management, IP, the product or service and market. And the advice that has been discussed on this call generally is just look at every angle, not just be blocked by we need finance and it's what kind of finance, what stage are we at, and that investor readiness, getting prepared. But for me, the management team plays such an integral part in this. But George, you want to talk to the technical aspects?
No, I think you're absolutely right. I remember the 3 C's of credit that I learned as a kid when I was a banker. It's collateral, cash flow, and the most important one is character. So we do want to see people, getting on with the product, really managing it. Most people are cash constrained, and there's no point about being ashamed about it and saying, if only I had another 200,000, I'd be flying. So what they need to do is come with something that's properly argued and as well documented as possible. And I think that there's a huge variety of possibilities by everybody in this panel.
Brilliant, thank you. So we've got a couple of questions actually that have come in that I'd just like to put to you all. So feel free to jump in. One of the questions is the pandemic seems to have caused quite significant changes in the investment landscape for startups. And do you expect the access to capital to change, to become more open? I think there's an inference there that it's quite closed at the moment. It's quite tricky to get. What's your views, please?
It's tricky just now, and with the repayment of CBIL loans, HMRC borrowings to act as cash flow during the pandemic, all of these factors are going to make it even more convoluted. Which plays to companies like ourselves and to UMi in terms of stepping in as debt providers. But the innovation space that Alfredo and James has alluded to as well, it's back to that, looking at every possible conceivable angle. But I think it is going to get bumpier in the short term. And sadly, the insolvency practitioners are licking their lips in anticipation of a tsunami at the end of this year into next year. So it's
Alfredo, James, Paul, is that what you're seeing?
I think on the corporate side, we've seen actually more corporates getting involved in innovation through the pandemic, and that perhaps is different. And in part that's good because it means the sort of corporate venturing world is a sort of more mainstream. It's more established. In previous sort of economic cycles, there's been a bit of a sort of retrenchment perhaps from certain areas. But really, we've seen increasing numbers of corporates coming forward and doing sort of first deals through the pandemic. And partly that's probably been caused by the disruption to corporate. It's kind of accelerated the need for and that sort of digital digitalization space, different ways of working, whatever it is, corporates have had to respond, and they have, and I think that's true of the sort of the wider VC market as well. I've actually seen sort of almost like record numbers of deals being done. So it's kind of, and we expect that to continue. That was there was obviously just after the sort of the pandemic struck, there was a bit of a but I think that was everywhere globally. Everyone was a bit like, oh my God, what next? But very quickly the levels kind of continued, and we've seen, like I say, sort of record numbers of corporates entering into the space, which is encouraging.
And Nicki,
any kind of thoughts on that?
Well, Nicki, if I could talk at that front end again, those sub £200,000 seed rounds, we've seen quite a few informal syndicates coming together. So high net worth individuals. We've recently started up an investment fund at the university, so we can match investments there. So we've seen that sub 200K is maybe happening through some high net worths. Yeah. So it could be, we did one, 6 months ago, where we had a corporate investor coming in, but there was also, it was a sports technology company, so there were some quite famous sports people came in to invest in that as well. So it takes a little bit more work, but then you're still got in mind, can we approach the syndicates, can we approach the corporate investors maybe at the next round? But those seed rounds, I don't know if that's here to stay, but we saw lots of those more bespoke ones over the last year.
Really interesting that you're getting those high net worths looking at alternative means of making their money work for them, I guess, because traditional means at the moment of investment through normal investment portfolios, etc., I guess, is quite tricky.
Yeah, I think we from our side, Nicki, we're seeing. I mean, last year had a massive amalgamation of effects. Of course, as James said, initially when the pandemic struck, I think everyone held their breath. Particularly, I think those high net worth family offices were trying to see, okay, do I need to shore out businesses that are struggling? How can I conserve some of the cash? How can I mitigate some of the losses? But then I think that really was transformed, and people were thinking about, well, hang on a second, how can I make this capital work? And I think the pandemic, on one hand, accelerated a number of trends, whether it is, I think it brought really to the forefront of our minds the fact that, look, we're facing a number of strong challenges here, for example, in climate change and in the environment as a whole. We're facing a number of healthcare challenges that will be going forward. And I think that has seen, and we have data basically that show that we've seen, renewed investment, increased investment into those areas that before perhaps were not being seen as that relevant, just simply because you could obtain higher returns somewhere else. I think we see more of a, let's say, the ESG agenda has also driven a different behavior in investors. Thinking about, look, this is not only about finding the highest return here in this particular space, which, undoubtedly, if you're looking on multiples of cash, probably the software side of things or the gig economy is what I've seen, the biggest returns as of late. And in fact, I think data from Bocher suggests that in the UK, from 2016 till now, about 57 billion have been investment in this space, whereas the investment in life sciences and other areas has only been around 21 billion. Although these are things that we need. And I think the pandemic accelerated the fact that, look, or the thoughts of people in terms of, look, these are things that we need. It's not only about, yes, we all want to make a return, but these are things that are fundamental changes. And you have a long-term growth prospect there as well. The other thing that we saw, of course, is in terms of just bare data, we had about, in areas where CPI is active, so this does include all venture capital investment in the UK. 2019 saw about 13.2 billion of investments in that area, mostly distributed across seed, venture, and growth stages. And 2020 saw an increase on that number. Now, you may argue this might be in funds that were raised earlier, and this was dry powder that need to be invested anyway. But the fact is that there has been an increase in investment in the last year. Truth is, it shifted more towards the later stage companies, which suggests that either investors wanted to strengthen some of their current portfolio companies, or actually look for things that mitigated the risk in a slightly different way.
Really interesting, thank you. Well, we're about ready to wrap up here. I just want to say thank you to everybody. I think that's been an incredibly useful session, and I do feel like it's dispelled some of those myths that exist in this world, and hopefully it's created much more open-mindedness in businesses that have been watching today or will watch in future around what investment means, because investment is quite clear from today's discussion is so much more than just the pounds and pence. It's about considering what access to broader resources, expertise, etc., that investors can bring to the party. And there's been some fantastic examples of how corporate venturing can do that. But really importantly as well, some of the other lessons or experience that comes across this morning is it's about team. Have you got that hustler, hacker, and hipster, I think, as Paul was saying, great phrases to keep in your mind. And then lastly, think about the stage you're at, and think about whether or not things like the grant network, but also R&D tax credits and the stuff that Factortech are doing as well can play a part. But getting involved with organizations like CPI, like GCV, like Heriot-Watt and Factortech is really, really important, because there's one thing that comes through super strongly this morning that is about connections and it's about networks. So hopefully it's been a little easier to understand now. Hopefully you've got some connections that you can go away and help, that will help you access investors and investment going forward. But do please join us at the Go Further Forum in November at Heriot-Watt. It is going to be a hybrid event. I'd love to see you there, because I can't wait to go and see the grid facility. But if you can't join us in person, then do join us online. And lastly, don't forget to nominate yourselves. If you are a business that's innovating, if you're a business that's attracted investment or in the process of attracting investment, then please go ahead and nominate yourself to be listed in the index. And they close on the 2nd of July. It's a fantastic way to build those connections and networks that's come through so powerfully this morning. So thanks, everybody. Great session, and really appreciate your time. Take care.